Welcome to this video, created from a live webinar we broadcast on June the 30th, covering Trade and Transaction Reporting, What Good Can Come of It. This is part 3, which covers what have we learned from the public data, what uses can you make of the public trade reporting data, and a poll asking people what is your firm using the public data for. Our speakers today are Brian Lynch, CEO of Riskfocus, Steve French, Head of Regulatory Services for Triana, Chris Barnes, a writer and analyst for Claris FT, and Gavin Dixon, a senior executive, ex-COO of credit trading at BNP Paribas. We hope you enjoy the video.
I just wanted to talk a little bit about case studies, really. I think it's all very well and good saying there's lots of data there and data has value. But particularly in the early days of transaction reporting, there was a great scramble to get at the data and to see what the DTCC was providing from the SDR. And I think every single market participant was a little bit amazed actually about how difficult it was to make any sense of it. Fortunately, as time has gone on, the quality of the data has improved, but also our ability to understand what's coming out of the SDRs has really improved. And I think one of the prime examples of that is the ability to identify CCP basis, even if you're not particularly involved in any given market. So obviously,
for the people who are watching, do you want to just take me through this graphic?
Yep.
Because I'm not into it. I think I know what it's showing, but I think you should explain it.
Yeah, I will do. So obviously, for transaction level reporting, the data is best for US dollar swaps traded in US time, particularly on CEFs. So what this chart shows is an intraday chart. It's from some time back in May, I think, of the 10-year dollar IRS rate throughout the day. Now, on a typical instrument, a typical financial instrument, you would see a relatively smooth progression of prices. What we see on this chart is far more jagged, and that is because what's actually happening here are that some of these 10-year dollar IRSs are being cleared at LCH and others are being cleared at CME, and you get this kind of zigzag pattern whereby the prices are clearly fluctuating more than you would expect for the fundamental instrument itself. So therefore, even though on the transaction reports themselves, it's not identified which CCP it's cleared at, what we can do is go back at the data and retrospectively infer that yes, two trades were traded very, very close in time to each other, and yet one of them was at a higher rate than the other. And that allows us to back out both the fact that there is a CCP basis, but also retrospectively, we can look at what that price of the CCP basis is as well.
And how long after the public dissemination of data started did the data become useful? I mean,
I would say the biggest step up in the quality of the data was when CEF trading was first mandated back in October of 2013.
Because I heard a very interesting anecdote about a kind of unwanted benefit of that public data, where a client we've spoken to had actually reverse engineered from the data who was trading what. They could tell from how various attributes of the data were represented, either capitalization or what codes are used, and who that was. And essentially, they built an algorithm to work out who was trading each trade, and eventually their compliance guys got hold of it and shut them down. But it clearly there was not a standardization of that data if it was so obvious that was one bank versus another who was submitting that public data.
I would be wary of extrapolating the logical conclusion of that. I would say on some specific structures, Yes, there are known clients who trade those specific structures. Therefore, you can imply a degree of counterparty knowledge. Whether you could ever identify that it is two specific banks on a given trade is highly unlikely. But that's not to say that you can't combine the pre-trade information you're getting and follow that into the public feed and say, I missed that trade, I know who asked for it. If we just go on to the next slide, which is kind of related to that point as well, actually. When we first started looking at the data, and if you were just to look at a price graph of 10-year swaps, for example, we'd find that there was a lot of variability in prices, even for trades that appeared to be trading very, very close in time. A bigger variability in price than you would expect given the volatility of the asset. And so we realized that actually the majority of trades that are being reported to the SDRs are not necessarily traded as a single trade. So you'll see things like a 10-year swap is typically traded against a 5-year, or a 10-year swap is traded against a 10-year treasury, for example. And over time, we've been able to refine how we look at the data, a lot of it based on matching timestamps, but also looking at different properties of the data. And you can actually infer what type of trade it is by looking at the trades traded around it. And the key takeaway here, one of the reasons the public data itself is quite difficult to draw conclusions from, is that less than 50% of trades are actually traded on an outright single basis. So you see
But that's in the US, yeah?
That's specifically in the US.
Right.
What's the little call out mean?
So that's actually showing that on that day, 46% of the trades on a risk basis, so on a DVO1 basis, only 46% of the trades reported on May 23rd were actually traded as a single standalone
Do you want to
trade.
briefly take people through the colours so they know what these things are?
Yeah, so the types of transaction that we identify are spread overs in grey, so that is a swap versus a treasury. Outrights, we've got in yellow there are curve trades, so a package of two trades of different maturity, so 2s, 10s, 5s, 10s. In green, we've got butterfly, so package of 3 trades, 2s, 5s, 10s, a classic example.
Green was compression.
Yeah, green's compression.
I'm a little bit colourblind, I'm afraid.
Light blue. Light blue, I think, is the butterfly.
Yes, yeah, we've got light blue as butterfly. Compression would be trades that typically are not spot starting, so either forwards or back starting, but traded as a package of more than 3 and all at the same timestamp. A compression package will typically be risk neutral. And then we've got things like roll and list in there as well, which are more portfolio maintenance exercises rather than at-risk trading. So those are 2 very, very specific use cases that we've done some research on, we've blogged on. And it can be frustrating as an ex-trader and a market observer now about what I'd be able to see having this public data in combination with the private data I know I would have as a market maker or buy side. And I think there are a number of portions of the chain that you can apply this public data in combination with your private data to. So as I mentioned before, pre-trade, there's a lot of information now on about what is exactly liquid. What kind of risk can I actually expect to get through the market without having to build either those years of experience or those relationships by picking up the phone, and saying what is standard market size in 50-year sterling, etc. All of that information now is freely available and part of the public data. And I think that's a big advantage pre-trade.
Is the MIFIR trade reporting data going to offer a similar opportunity?
There are differences definitely in the fact that it's a T+1 basis, but for the research in terms of combining your private and public data, there's a possibility it offers the same level. The grey area for me at least is whether we're going to get transaction level reporting on a T+1 basis, or whether we'll see the RFQs coming in, but we won't see the end result.
I'll just add one comment to that, and I think it's on one of your bullets. So, but best execution is like,
yeah, exactly.
with MIFID coming up, is just going to be an absolute nightmare. I'm doing a panel next week where I'm moderating one on best execution for the OTC business, and public data combined with private data is going to be one of the key elements to be able to prove, best execution going forward. So I think, the creation of that is going to be very, very important.
Yeah, agreed. I mean, for us, from our experience of that list, the most common is tracking the market share. Whether that's taking feeds from CEFs themselves and combining with the public feed, whether it's about taking the internal data, or whether it's about the CEFs themselves monitoring their market share. That is, for us, of that list so far, tends to be the most common use case.
Looks like no one's looking for off-market trades, that's for sure.
Nobody from compliance is on the
Yeah,
call.
wow.
We've only had about a third of the attendees voting, so I'm not statistically, this is probably not the strongest sample of data, but nevertheless.
Yeah.
Okay.
So at least some people, to be positive, some people are using it, beginning to use it, and I guess our mission here is to encourage people to start using the public data.
Yeah, absolutely. If there's one takeaway I would like people to get, it's that you can read our research and see what we draw from the public data, but that's only a drop in the ocean compared to the amount of value that you can extract by combining it with your own private data.
The answers may depend on the audience and the roles that they play within their own firms as to whether they use public data in any way, shape or form. Compliance departments, if we had them on, I'm sure would be very keen to discuss some of the things they could do with it.
Yep.